Welcome to Exit Engine Podcast, Episode 14.
Hey, John.
Joe, how are you today?
Doing great, man. How are you today?
I'm excellent.
Very cool. So today's kind of special because we're going to talk about everything we're going to talk about today is going to come from the buyer's point of view.
Excellent. Very important point of view.
Perhaps the most. In fact, everything that we do at Exit Engine actually starts and ends from the buyer's perspective. Even though we don't really work with buyers, the reason is that we need to understand what it is that buyers want so that we can make sure that they get it, right? And we understand that we're in a situation where the buyers think, not always true, but they think they have a lot of options. They are, in many cases, investing their own money. They're investing potentially other people's money.
Yep.
They are trying to make a very, 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 very good decision when it comes to what company to purchase.
Yeah.
So what we have to make sure we do is that they're going to be very, very, very careful. They're going to look under every, right? They're going to look under the rugs. They're going to look behind the curtains. They're going to look in the closets. They're going to look under the bed, right? They're going to look at every single thing they can possibly look at to, in order to basically, to be able to make sure that they're making a good decision. And so it's up to the seller, if they want to sell the company, to not only have a good valuation and not only have a good propensity to sell, but it's important for the seller to be able to meet the buyer's expectations.
Yes.
Right?
And also, you're right, without 100% correct in all of those things. And also realize the seller has to realize that even though their company is very different from the other companies that the buyer is looking at, invariably that buyer is going to compare your financials and your market position with all of the other companies they're looking at, because trust me, they are looking at multiple companies. And the way these buyers work is they have lower level associates look at a lot of these deals, and they bubble things up to their manager, and then that manager bubbles things up to their manager, and it eventually gets to the investment committee, and they choose the best of the best in which to proceed in many cases. And again, a lot of firms operate differently, but many firms operate in this way, in the sense of you are being compared to other firms, either in your industry or out of them, based on a timing thing that the buyer is looking at, in when we are right now in October of 2024, as an example.
That's exactly right. And of course, because they are looking at all these companies, they consider themselves an expert in your company. Now, they may not be an expert in your company yet, but they are an expert in the industry. They are looking, and in the case of private equity firms in particular, they are looking for companies that are in a particular category, right? They think that they can take on this company and manage it moving forward and grow it. So they believe, right, that they've got the expertise, they've got the ability. All they need in their minds is a good starting point. Right? They need a solid foundation. They need a company that's doing well, that's got momentum, that is able that does not have an owner that's getting in the way of stuff, right? They is a healthy, financially healthy, has good processes and things like that. And there's going to be some things that it doesn't have that the buyer maybe wishes it did, right? But we're also going to be able to turn those things around and to show the buyer why they need to have the things, why the opportunities exist, so that there may not be things that are not complete yet, but may be opportunities for the buyer as well. So we're going to want to point those things out. So let's start by talking about the motivation of the buyer.
Yep.
Okay. So obviously any buyer, and again, this is what we'll try to do here is we'll talk about the different kinds of buyers that there are. Okay. And let's talk about those real quick, because I think it's important. All these buyers will be slightly different in terms of how they approach your company, how they approach their process. And then even within individual, private equity companies as an example, and there's literally thousands of them. I think the last count was 9,000 in the United States alone. Okay. So a lot of companies with a lot of money a lot of personnel, a lot of staff. They're all staffed differently. They've got some are very large, some are very small, some are very nimble, some are very robust and take a long time. It's important for the average person to know too, though, that the private equity thing, and this is just a little bit of an aside, but understand that much of people's 401ks and retirement funds are actually tied up in private equity funds. They may not even know that. So some of these companies most of these companies are using other people's money. They're using money from institutional investors. And so they're going to be very, 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 very careful, right, with that money. They're going to make sure that they're making a good bet and that they're doing everything they can to buy a healthy company that they're going to be able to grow, right? So let's talk a little bit about the different kinds of buyers there are. Okay. So John, let's talk about private equity groups first.
Yeah. I mean, private equity groups, they run the gamut from one person and an office, one person and a desk to, hundreds and thousands of people that are the largest investment firms in the world. But primarily what they're looking to do, and Joe is very good at pointing this specific thing out, is they're looking to buy companies where they can make a return and make a large return by twisting a couple of knobs and changing a couple of things of the company. And by changing a couple of things, it could mean changing the capital structure of the business, taking out existing debt as an example and replacing it with lower cost debt, or making the company's product available to its other portfolio companies, and having like an ecosystem, if you will, of they're all buying their own products. Again, perfectly legal and a good strategy. But they range from people who have very long-term operating horizons, indefinite, like people that just like to buy companies. Like if you think of Berkshire Hathaway, although they're not a private equity firm, they operate very much like one in the sense of they bought See's Candy in 1965, I think, and it's returned an incredible amount of money. Why would they ever sell that company? So big private equity firms and long holders of private equity that want to hold for the long term can buy a company, roll it into its portfolio, and just print money, and they essentially are the bank for that company. Other companies look to have a time horizon of 5 years or 3 years, and often those horizons are dictated by the investors of that private equity firm.
Right.
The fund, if you will, that has been raised has a time horizon, be it 2, 3, 5, 10 years. And the investors in that fund are required to take a distribution from that fund when that fund ends, and that fund definitely ends. So they have, as an example, they could have 36 months or 18 months to put money into companies, and then a time horizon of, let's call it 5 years, to realize those gains. So they have to either have a financial harvest in those 5 years. So they're encouraging companies to accelerate growth plans, and all of those companies in that private equity's portfolio have a 1, 2, 3, 5 year time plan to get them going. Some of them will be successful, some of them won't be, but the private equity firm is betting that a majority of them will be successful, and then they get a couple of really big returns, kind of like venture returns. Right? It could be 10x, 20x returns in those private equity firms, and then they're going in and again twisting a couple of dials, going in, bringing in maybe a management team member, some financial strategies, and some operational strategies that they've honed over the course of their investment career to make the really big levers can twist to make the biggest financial return, because that's what they're really looking for. They're looking for a financial return. That's
right. They're financial buyers, right? At the end of the day, their interest is purely financial. They're not. They are grouping companies together sometimes. So it might be that there are portfolio companies, which are the kind of the main thrust, I would say, in that particular industry, and then they may also purchase add-ons, which are things that they may actually purchase after they've bought a portfolio company to add on as a service or product, kind of add on to the existing portfolio company and kind of integrate them, those two companies that way. So,
right.
Good.
Yeah, like a roll up strategy, right?
Right.
A lot of people have heard of roll up strategies. That there's a bunch of companies doing that with HVAC and plumbing companies and roofing companies, and they roll up roofing companies across the country, have a central management team, and roll that up. The other roll up strategy that I was a part of early in my career is they're rolling up different providers of financial information, as an example, and slightly different providers, but the goal was to compete with a company like Bloomberg, and rolling up all these specialty information providers to roll up to one company, one management team, different products. And that was the sort of synergies, in that they could have all of the shared services of the IT and finance would be shared among these products, one management team, and they would gain and gather efficiencies in that way, shape, or form. So.
Right. But the idea is that these people are basically have a purely financial interest, right? They're not looking for prestige. They're not looking to have a boring business they can make money on in the short, in over a long-term play. They're looking 3 to 7 years. They're looking to resell it, maybe offer as an initial public offering and take it public.
Yep.
But whatever they want strong cash flow, and they want profitability, right? And they want the ability to see immediately how they can grow it in the immediate future.
Yeah, and they're doing that during their due diligence, right? They're
Right.
looking at the financials of your company, and they're looking at, okay, what are those 2, 3, 4 high impact things I can do with this company to make a giant financial return?
That's exactly right. And so their motivations are, again, purely financial. It is all about the growth. It is all about that. But that's just one type of buyer. Okay. Another kind of buyer is what we call a strategic buyer, right? Now, these are companies that are looking to complement existing operations. So I'm going to buy a company like that same roll-up strategy that we just talked about with a private equity firm. The difference is that I am an owner operator of a company, or I'm a group that owns and operates a company, and I am now looking to grow the value of this company by adding on a service or kind of other strategic offering, so that I can find synergies, expand market share, diversify product offering, any of that stuff, right? And that's going to give me access to potentially to do new markets, to new customers, new geographies that I didn't have before. And we're going to basically potentially eliminate competition, right?
Yep. I think of this. When I think of this, I think of adjacent markets, right? Markets that are, adjacent to your product. So along the lines of HVAC and plumbing, right? Just as a thought, if you have HVAC people, oftentimes they need a plumber. Oftentimes those companies need plumbers and services. You might be a plumbing company who gets into and starts purchases and a complementary business, a business like HVAC or something along those lines that you can sell a similar product to your existing customer.
Right. So you're finding efficiencies, right? You're finding, again, same thing, one management team, right? But you might be expanding a product offering or expanding into a geography you didn't have before, right? You're reducing your competition, whatever. So overall, again, a completely different kind of buyer with a completely different mission. This buyer obviously is still going to be concerned about the financial aspect of things. They want to make sure that they're getting something, but what they're really interested in is going to be, how well is this company going to integrate with what I already have? Right. Yeah. That's a much different question, right? There's going to be a lot of focus for them on how we can actually emerge successfully to meet the end that we're trying to meet, which is to grow the value of the company. Right. And so a very different mindset.
Yeah. And also, like the way that the private equity the way that those buyers approach different companies and the time horizon for those companies, are different. Oftentimes a financial buyer often comes in and buys the company and is like, all right, yes, you have some type of transition period, but it's relatively quick because they want him to go in and make those changes. A strategic buyer, not all the time. This is every situation is different, but oftentimes they might not know the market as well as the existing owner. Right. So they'll want to retain the owner for some period of time after the acquisition is finished as an advisor, as a equity owner, roll equity into the new company or something along those lines, so that they can keep the owner's expertise within the fold, so to speak, to help them roll the strategy out.
Exactly right. And so that's something that's going to happen, obviously, with a more strategic buyer. And you could probably break the strategic buyers down into a couple of different things too, right? So the most common kind of strategic buyer is going to be like a competitor, right? Somebody who potentially is interested in you because they compete with you, and in order to basically kind of get you out of the way or buy more market share, they could potentially buy your company because it would be an easy thing to roll up. You're in the same industry, maybe you're doing things similarly, but that's something that's a very common thing to have happen, right? Probably actually one of the more common ways, would you say, John, in terms of finding a buyer?
Yeah, I mean, this is what I used to do in one of my companies. Is we would look for companies in our industry that were either slightly out of our geographic area or within our geographic area that we didn't have a good footprint in. Like, right, we had one company where they had a hammer lock on this one city for real estate, and we purchased them because it was really the only way that we could get into that city.
Right.
So we had a market share there. It was very small. We were always very small. I think we were fourth in the market. We immediately went to number one in the market. Also, it's geographic expansion, right? We also looked at companies further away from us where we had a very small market share, but hey, we wanted to be in that market. This company dominated the market, and we got turned down a lot when we made offers. We had to buy, the Avis of the locale because they were available and the number one company didn't want to sell. I think of that in the state of Connecticut, one particular area. We could never buy this one company. They were number one, but we tried to buy number two. So those are types of expansion strategies where oftentimes you can't buy the number one company because they don't want to sell. You buy the number two, you combine the fourth and the third, or the fourth and the fifth, and become all of a sudden you're number two, as an example.
Right. And this is something that probably a good time to point something out here too. If anybody out there is getting calls from competitors or other strategic people within their industry looking to, and it starts talking to you about an potential acquisition, answer the phone, take the phone call, say, thank you very much, this is very interesting, and immediately hang up and call an M&A advisor of some kind. Okay.
Yes.
Whether that's us at Exio, at Exit Engine, or somebody else out there. There's plenty of people out there. We can give you recommendations if you don't want to work with us for some reason or whatever, but please, your very next call should be to an advisor. And the reason is that you don't want to go out this alone. Okay. You really don't. Keep in mind that even strategic buyers, okay, may have done this before. They may have a lot more experience than you do in terms of what they're looking for. I can guarantee that you're almost 100% of the time, you are not ready to sell, even if you want to sell and you get a phone call. Okay. There are things you can do. There are things you must do first before you accept an offer or start entertaining any kind of offer from anybody. Trust us on this, right? It is not something you want to handle completely alone. Okay. So whatever, you get an offer, they make you an offer. And remember, guys, too, that the offer they tell you on the phone, okay, is just not real. Okay. Until they get in and they really uncover and they really look at your books and the whole thing, that offer is going to change, and it's not going to change up. Okay. So
it never does.
Right. So just know that is the time. If you are getting phone calls from people who are interested in buying you, whether they're private equity companies or competitors or other strategic or financial buyers of any kind, stop and call a professional in and get some advice before you move forward. Okay. I'll leave it there, but that's really important.
And I'll echo that. And every time we would buy or try to buy a company, we would always get a phone call back from that company's advisor, right? Joe's exactly right. In the sense of they're the people like us, we do this all day long. We talk to companies, we talk to buyers, we know the lingo, we know what they're going to ask for, and more importantly, we know what these buyers want. And it doesn't necessarily mean it's industry agnostic, right? They all want the same thing. They all want what we're going to talk about today, right? We're going to get into some of these things, financial records. They want to know the growth potential, all those things. But it's best left to have it, or it's best to bring someone in with expertise that can ask the right questions of the buyer and provide the answers in context. And you don't want to make a mistake that lowers the valuation of your company on that first phone call.
That's exactly right. And we know not only the questions to ask of the buyer, but to be honest, we know the questions to ask of you. Because at the end of the day, as the seller, there are some things that there are some hard questions you're going to have to ask and answer before you're ever going to be able to sell your company. All right. And so, okay, we've talked about those in the podcast. I mean, we a couple of weeks ago, we talked about the 10 things you can do right now, right, to raise the value of your company and things like that. Those are similar questions you're asking yourself to be able to find out the answers, to then be able to make a plan on what to do, right? So understand that anytime you're getting a phone call from somebody or whatever, you just don't want to, you take it, say, thank you very much. I will get back to you and leave it there. And then immediately turn around and call us. Okay. Just trust us. You don't want to make this mistake. So back to the discussion though, we're talking about different kinds of strategic buyers. So you've got some buyers that people don't consider. Okay. Besides the competitors, are going to be things like family members, all right, potentially selling it or at least succeeding, having a family member succeed you. Maybe it's not necessarily through sale, like the exchange of money, but potentially through a will situation or as part of your exit strategies to hand over the management of the company to a family member, your son, your daughter, your nephew, whatever. Also, now what they want to do, okay, or what they're going to do with it is going to be yet again different. Okay, what they're interested in that case, okay, is again less. To be clear, everybody's obviously concerned about the financial state of things. Okay, that's just a given. But these motivations are above and beyond that. Okay, they may be interested in family legacy, keeping control of the organization in the family. They might be concerned with preserving, longer term relationships with employees and customers and partners. They may not want a sale to throw that off. And they're more likely to have an emotional attachment to the business too, right? So those motivations are, as you can see, those are much different. Employees are another potential buyer, right? We call it a management buyout or a leveraged buyout. You've heard these expressions before.
Yep.
This is essentially when your management team gets together and buys the company from you to be able to run it themselves and move it on. Again, of course, they're concerned with the financial health of the company, but who knows what the company is more than that, right?
Correct.
So they're looking at the continuity. They're looking at continuing the operations, continuing the culture. They're looking at maintaining the business, right? And being able to potentially do more, potentially with you out of the way. Okay. They don't need your training. They don't need you to stick around for 6 months or do any of that stuff, probably. All right. So that whole deal looks different than it would if it was coming from a private equity group. Right.
Yep. Agreed.
The other, again, there's some other specific buyers that we could get into. There's ESOPs and all kinds of things like that. We don't need to touch on that today. We will talk about employee stock ownership plans. That's an ESOP, and that's actually something that that's actually a very good strategy for some people that are looking to be able to get equity, but don't want to, but basically don't. It's basically making a trust. And you're selling the company to a trust. We can talk about that in and of itself. There are foreign buyers too. All right. So some cases, again, doesn't happen that much this way. Usually it's happening the opposite way, where there are American companies buying, companies from other countries. That has just to do with the size of our market and things like that. But that's another potential situation, right? Is that you be picked up by a foreign buyer. That foreign buyer, again, could be individual, could be strategic, could be, some kind of private equity or investor fund. So again, it's not really much different. But again, there's going to be a whole level of things that are different there, right? There's, this new market. There are rules about, cross-border rules and things like that. There's all kinds of things that are going to factor into that.
And that's another, going back to Joe's point earlier, if you get a call from anybody, but especially if you get a call from someone out of the country, you want to leverage an M&A advisor, because a lot of these sort of, and everyone sees the scams, everyone sees the spam you get and all those things. Like, you just got to be careful about what information you're providing to anybody. You want to make sure they're legit. You can do Google searches, but but M&A advisors like us, we have access to databases that aren't retail databases that quickly lead us to believe that some of these people are not real, and we can lead you down the right path when you get in contact by a random person in some country.
I can remember there is nothing there are very few things in life that are as exciting as someone calling you and saying, I want to buy the business that you've been working on for years and years and years. It happened to us. It's a great feeling when you're like, oh, and sometimes depending on when it happens, it can be out of the blue. It can feel like it's, you weren't expecting it. You were head down running the business, and now suddenly you get a phone call. It's like, someone's interested in this. You're like, wow, really? It's so exciting, right? Because it opens up a whole bunch of possibilities for you. Maybe things you never even considered before. But
that's exactly the same thing happened to me. As I remember, we got a call right after I had been in on a Saturday night at like 11 o'clock fixing something, which was a nightmare. But like literally 3 weeks later, we got a call from somebody, and they said that exactly from a private equity firm. We're like, wow, we've been they said something to the effect of, we've been watching you. And maybe that was sort of the line to get us, but then they came back to us with actual things that we had been doing, and like, wow, you heard about stuff that wasn't announced to the public, that they heard about. Oh, they had done their homework meetings. We were doing this and doing that. So it's interesting. So
it's an exciting thing, and it's easy to get carried away with it, right? And of course, if it's one of these, there are people out there that are untoward who are trying to scam you and things like that, and of course, that's the kind of thing you just want to obviously look out for. So good advice in general is just to call your lawyer, call an M&A advisor, call us, whatever you want to do. Call us for free. We won't even charge you. I mean, you want to talk about someone you're getting, we'll let you know right away. We're not interested in people getting taken here. So if you do get a call like that, let us know. We can potentially help you out with that. Let's talk real quickly though about individual buyers, because this is something that I think is also an under. We spend a lot of time talking about big buyers with with private equity groups and investors and things like that. And the strategic buyers are kind of a close second, but individual buyers are real, and they're really out there. And depending on the kind of company that you have, it's very possible that you could attract an individual buyer. What is an individual buyer? It's an individual. Obviously, it's a person. It's an entrepreneur normally looking to be able to buy, a stable business. And again, it could be part of a portfolio that they have. It could be a single business that they want to run and operate for a long period of time. It's not a bad plan. Okay. If you are pretty good at business, and you understand the numbers, and you understand, basic things about business, it's not a terrible investment strategy for you to buy I had a buyer once. His whole mission in life was, he was in his late 30s. He had been a financial guy at a big consulting firm for a long time. He made a little bit of money. What he wanted to do was as he said, he wanted to buy a boring business that he could run for the next 20 years with really good cash flow that he could then in 20 years sell for a major profit for retirement. Right? So think about that. Not a bad idea. Okay. If you can stomach the boring business part, and I think a lot of people could stomach it depending on how much money they were making every year. He was looking to basically make $200,000, $300,000 a year out of the business, and then hold on to it for about 20 years when he was ready to retire, and then be able to turn around at that point and sell it, to be able to fund, the rest of his retirement. Right. Really good plan when you think about it. Right.
Yep. So, I had a situation similar to that, different age of person, but they had worked. I'm not going to say the industry, but they had worked in an industry for a long time. They wanted to get out of that industry and move across the country, and they wanted to buy a lifestyle business, not necessarily for them. They wanted to buy it for their kids. So the motivations and the financial return had a different time frame than private equity firms. Right, had a different. They wanted it as a lifestyle business so that they could make not even that 200 grand. They just want it to cover their expenses, and sell it in a couple of years, or even pass along to their kids. So
And there are huge advantages to this, right? I don't have to go through the startup phase, right? I don't have to go through the hard years, right? If I can buy and I can afford to do it. And again, there's many ways financing wise. And again, we're going to do a whole episode on financing, and there's so many different permutations of that. But if I can swing it, if I can go and I can afford to buy, a decently run business that has a good history, that is profitable, that is established, I don't have to start from scratch, right? I get this, I get in there, I have instant income, right? And I'm able, and if I know something about something, I can potentially affect some change in a certain direction. Maybe I'm a marketing guy like me. Maybe I'm just like, okay, I can do this. And what I would do is I would go after these markets, and that's how I would grow the thing over the next years, while all the people who have been working there for 10 years or 20 years or whatever it is are actively running the business and doing what they've been doing. And all I'm doing is coming in as the new owner saying, keep doing what you're doing. And then we're going to try to do some new things by going into some of these new places. So it's a really good opportunity, right?
Yeah.
And it's, it gives you, again, it might be a lifestyle thing. It might be, again, a plan for later for retirement or something. It might be adding it on, again, to a portfolio that I manage from remotely, because I just put people in charge of these things and I just own these things. Maybe I don't operate them at all. So there's a lot of different, that's a real category of buyer. And I know it seems like it's like, well, they are probably the smallest group, but it's becoming more popular. So one of the things that you should know is that there are people like us who are out there actually working with individuals to become buyers of companies. Okay, so it's an investment strategy. It is a way that if you've got a little bit of knowledge in a certain aspect of things, and you can buy a business that is well established and is running, it's instant income. You don't have to build anything. You're just allowing it, and maybe you're, again, adding to it as best you can. Now, there are risks to that.
Yeah.
All right. So those are the kinds of buyers that, there's probably a few more out there that are less common, but I think that's the big group. Okay. So again, they have got different motivations, but I think what we can do is we can kind of boil them down to basically like three or four different total motivations, right? They're either motivated by the finance and the goals of the financial aspect of things, like private equity firms or investors and things like that. Like a strategic buyer, they're concerned about strategic fit. How well can I integrate it? How well can I integrate what's my culture versus that culture? They're going to look at things like that. Culture is going to matter a lot more to people like that than it is to potentially to private equity groups. And then, of course, there's things like, am I going to get, is there a lifestyle involved in this? Am I trying to buy something because I want to run it for a long time? So those understanding the buyer motivations are going to be really, really, really key, right?
Yep, absolutely.
So let's talk a little bit about specifically what these buyers are actually looking for specifically. All right. So the first thing obviously is financial health, right, John?
Yeah, I mean, when you're looking at a company and they have financial statements, and it's happened to me where I send a note over and I say, I want X, I want Y, and I want Z. And overwhelming of those X, Y's, and Z's are, I want your income statement, I'd like your balance sheet, and I'd like your cash flow statement over the course of, let's call it, the last year, as well as the last couple of years, and oftentimes 2019. And we've talked about this on other podcasts, but yeah, exactly. I want to know what the business is doing before the pandemic. The easiest way to do that is to look at financials for 2019. I know your financials for 2020 are going to be a mess in most cases, but do you have them on hand? Is it easy to send them? Do you have a cash flow statement? Because when you have, the cash flow is really where the cash goes and what have you been doing with it. You've been taking it out of the business and putting it in your pocket. Fine with me. I'm not making any judgments. You've been plowing it back into the business and expanding. Wonderful. You haven't been doing that. That's fine. I just want an accurate picture of where the cash is going and what you're doing with it. If you're buying machines, if you're buying things to make the business more productive, great. If you're spending it on a house in France, fine. Then the business is able to support that level of spending. But what you need to have is accurate financial statements that you can send over to people without a lot of explanation, so that they can make a determination about your business independent of a long conference call or email from you. They need to be able to, and they will do this anyway, they will put together the story of your business from your financial statements without you. Because even if you do tell them a story, they will put it together and say, oh, like, what happened in the second half of 2022, or what happened in the first half of 2019, or where was your PPP loan? Like, there's a set of questions that every buyer is going to say is like, wait, why didn't you do this based on this? Or what was the thinking here? Because every strategic decision that you made in your business over the last 3 or 4 years, you presumably thought about and had different options. Should we invest in A? Should we open an office in, city B? Should we do these things? And there are reasons why you did that. They're going to ask you those questions, and they'll come up in discussions.
And one of the best things, the thing that we recommend doing is being proactive. So we're not going to send a big email that says, hey, this is the thing, and by the way, this is why the cash flow was like this in 2019 or 2020 or whatever it is, or make excuses or whatever. What we're going to ask you to do is, and you can do this for yourself as well as anybody else, is to basically actually paint the picture. Here is this business, right? We put it all in a document. It's called a SIM. It's called, right? It's a confidential interest memorandum, information memorandum, SIM, CIM. And basically what that is it's your business in a nutshell. It's your marketing document. It's the thing that you say, this is the business, this is what it does, this is the highlights, this is the price, this is how it's set up, this is what the things I'm looking to have as part of the deal. This is where I believe the business can succeed moving forward, et cetera, et cetera. So
and it'll be anonymous, right? It'll have a industry. So if you're if you're a candy maker, it'll have confectionery company or food company and something like that, or it'll be generic, but it'll be specific with regard to some of the details of the business, so that we don't want them Googling the company or trying to find out the company, but they'll want to know the specific individual data, and that will come after an NDA and all those types of things. But
right.
Yeah.
So the idea is though, so when we say that, again, they are going to make their own conclusions, but it's important obviously to realize that they have motivations. And what we're talking about today, okay, is what those motivations are, so that you can appeal to those motivations. Just like selling anything else, right? What you want to know is, what problem do you have that I'm going to solve, right? Because that's, at the end of the day, how a deal gets done, right?
Yes.
So the financial health obviously is one thing. So this SIM, this information memorandum, is basically a marketing deck. This is what the company is. This is, it's going to include the financials. It's going to include all the things that we've done in the last few years to get here. It's going to include potentially ideas about where the business could go moving forward. It's going to be everything together in one document that's going to get sent. Now, that document is not going to be sent to as John just mentioned, until an NDA is signed, right? Well, this document is not going to, is going to have some information that's not going to be allowed to be seen by the public. We don't want everybody. You may not want everybody to know that you're actively selling the business. Why? You may not want your competitors to know that you have this thing, because maybe you don't want to sell it to them. You don't want to give them, you may not want to worry your customers.
I was just going to say, you don't want to let your customers know before you've had a chance to discuss with them the fact that you may be selling your business.
And there's nothing to discuss with them until you're actually selling it, right? And so there are things like that. So again, this is why this is a confidential situation. It is only given to people who have signed, an agreed upon, non-disclosure agreement. And they can only see these details because they've signed that. And that is a legally binding document that if word was to get out or whatever, that you could actually track it down and potentially sue somebody for breaking that agreement. So it's a real thing, but I cannot stress enough that it's when you are met with a buyer, understanding who that buyer is, where they come from, where their money's coming from, what their motivations are. Okay. Most important thing to learn before you ever give anybody anything is to find out the answers to those 4 questions. Why are you interested in this? Where do you come from? Well, how much? Where's your money coming from? Right. And what is your motivation for buying for looking at this company? That's the most important thing.
Yeah. And that third one is, a lot of these questions you have to be blunt, and you have to be upfront, and you have to be honest, and you have to get this information, because the worst thing to have happen, and it's happened to us, is you get going down a path, and what you've been talking to is like what they call, various names for it, but companies that don't have any money that will use your company to raise money, right? They don't have a pool of capital. They are a search fund, and they are searching for opportunities, and then they will raise money. That just complicates things. I'm not saying I don't want to disparage those types of companies, but it's good to know and get that answer up front, because if they're not being honest with you about the source of their money or the fact that they have money, that's going to complicate things, and it's going to add time, which may be very important to you if you want to sell the company quickly. And it can also lead to situations down the road where they start to lowball you before they have any money, which again has happened to people that we know and people we've worked with.
No question about it. So, and again, this is why you want to pass this on to an M&A advisor if you can. Okay. We know the questions to ask. We know how to get to their motivations. We may even know the people potentially who are coming after you. So just know that that's something that can be incredibly helpful. So understanding their motivations. Okay. And the reason that you want to, again, the reason you want to understand their motivation is because you want to be able to couch your product, i.e. your company, right, in the right light. You want to be able to say, okay, if your motivation is this, you may say, hey, if your motivation is purely financial, then I don't want to sell to you. Right. You may feel that way. You may say, no, look, the only way I'm going to sell this company to somebody is I'm either going to sell it to an employee, and I know which employee it might be, and maybe that's 3 or 4 or 5 years down the road. But I know that I would entertain a strategic buyer, someone who came in and said, we really like the way that we do stuff, or that you do stuff. They like they like your operation. They like your culture. They see themselves being a part of it and putting it together. You can make that decision. This is what exiting on your own terms means, right?
Exactly correct.
You decide what it is that you want to go. More deals fall apart at the table because the seller gets cold feet. The seller, about 30% of the time, probably, okay, that there is something about the buyer that the seller does not like. Okay, it's very hard to be a buyer. I mean, it really is. You have to do a lot of due diligence. You have to think you're very right about the purchase you're about to make. All right. And so they really do you talk about due diligence. They really do due diligence. Okay. I've had buyer clients that I have put 30, 40, 50, 60 companies in front of, and they have not pulled the trigger on any of them. Okay. They want to be very, very sure. If you really want to sell your company, then what you want to do is understand exactly what they're looking for, and then decide how you can position your company to make that fit. Right? Not going to be 100% of the time, but at least you want to know what you're up against and what they're really into it. What you don't want to do is talk to a lifestyle buyer, about the way that he can make money in the next 3 years by selling the company. That's not what he's in it for. Right?
Correct.
So making sure that you understand this. What buyers are looking for. Let's talk a little bit about specifically what they really want. Right? They want what? They want financial health in general.
They want operations. So like they want to
Right.
know that what they're buying is repeatable, and scalability is part of that, but it's not required. It's a nice thing to have. But if the operations are documented, the processes are documented, and the potential for scale is possible, right? You're a restaurant, you're some type of offering to retail, and some unique offering for retail people or for consumer, directly facing consumers, and it can be repeated across geographies. I think restaurants in this case, or something along those lines. That's what they want. They want to be able to come in, and without the owner, they assume that the owner is going to be gone, that you're going to leave the company and you're going to be doing your next thing, or you're going to be on a beach in Cabo or wherever you want to be. They want to know that that business can run itself. Sure, they're going to be involved, but if they're financial buyers, they want the business to run themselves. So they want manuals, processes, intelligent people that can run the business, that are going to be there after the sale so they can manage the business that they've just purchased from this owner who, yeah, maybe there's an earnout associated with it, but clearly he or she is not focused on the business in the way that they were focused on it when they owned 100% of it. So
That's right.
Those types of things are appealing to buyers.
And of course, they also want to know, most of the time, whether it's strategic or financial or otherwise, they want a company with a good reputation, right? They want to buy. They're not looking to buy. There are people out there that buy distressed assets and things like that. That's a thing that exists. There are companies that will just buy your equipment. There's all kinds of things that when you're in trouble that you can do to get cash. But when you're talking about selling the whole company, the reputation of your brand in general is probably one of the biggest issues that there is, right? What do your customers think of you, right? How much market share do you have, right? What are your employees and your suppliers think about dealing with you? Those are things that really, really matter, right? And again, they're not necessarily the things that you're going to think about when you're thinking about the price tag you're going to get for your business, right? But all of these things matter. So having all these things, your ducks in a row in this situation are going to make a big difference.
Yeah, and just to build on that, as the last thing is about customers. Again, they want to see a broad customer base. They want to see the not too much concentration. They want to see that they're buying different products from you if you have multiple products. Those types of things are very positive when a buyer is looking like, oh, they buy 4 different products from you. Okay, that's great. That's helpful.
And again, some work at looking at yourself before you put your company on the market is to be one of the key things is to be able to look at that customer concentration, look at your products, look at the things that maybe aren't selling and maybe actually get rid of them. Right.
Yes.
So the idea is that understand that when you're going, this is why, again, guys, we talk about this exit planning situation. Okay. Is not just about, I'm ready to sell right now. Let me start. Okay. It needs to be done early and often, like voting in Chicago. You got to be able to, it's not funny anymore. It used to be funny. But the idea is that being able to, understand your business to a level at which, that you want to be able to understand every single ins and outs and every nook and cranny before you're in a situation where someone else from the outside is looking in on this stuff. Right.
Yeah, exactly. To the extent that you can fix any issues that you think the buyer would find before they find them. And we're not talking about hiding anything. We're talking about if you have a known problem at your business, reliance on a key customer, reliance on a key employee, whatever it may be. Again, think of what you would want as a buyer. If you would want that as a buyer, it's reasonably assumed, and you can reasonably assume that the buyer wants that too. Say, wait, we're too responsible, or we're too reliant on Sarah, who's an expert in this stuff. It's too risky for us if Sarah leaves, or we're too reliant on ABC Industries because they're 55% of revenue. Try to solve those problems and try to diversify your client base, diversify your employee base to spread things out. Make Sarah an expert, but don't be so reliant on her that without her, a buyer wouldn't want to buy the company.
Yeah, exactly right. So we know we've talked a lot about some of the things that are like red flags, right? So the things that a buyer sees and is basically going to be like, whoa, stop the presses, like right away.
And we just talked about a couple of them, right? We talked about financial records, right? If you have financial records that can't be pieced together, I mean, I've had this a couple of times where you look at the financial records and you can't make sense of them. In other words, we had one situation one time. It was the revenue for the 4 quarters wasn't close to the revenue that for the whole year. And I was like, well, what is going on? And I kept asking the question different ways. I said, how can the quarters, and I looked at myself and said, am I looking at the right information? Did you send me the right information? Because it was not close, right? So, and it turned out that the label was wrong on information was sent over, which is a mistake. It happens. But inconsistent financial records where you can't get a cash flow statement for the second half of 2022, that's a problem. Your balance sheet doesn't reflect, a PPP loan that was forgiven or some type of debt. you don't have all the shareholders in your company. Oh, Uncle Norman owns 20% of the business. I didn't know about Uncle Norman.
Right.
And that actually happened. It wasn't Uncle Norman, but it did happen where
It did
there
happen.
were people that were owners of the company that sort of came out of nowhere when we were buying the company. It's like,
There's another owner. Oh my God. Remember that? Oh my God.
that's a nightmare. That's a nightmare. So those are things those are table stakes. You need to have your financial records. And anytime that you don't have that, it's a major red flag.
It calls into question other parts of the business. How do I know you're telling me the truth?
How do I know that you're not a liar? Right. That's the thing that if you make a mistake, everyone makes mistakes. But if you consistently, or you've on a couple of occasions sent over misleading or incorrect information and you didn't immediately try to correct it and explain what happened, that is a red flag too. And that's a symptom of a larger problem.
And by the way, you should know that again, everybody in this community is largely connected. Okay. It's a very small community. The reality is, and we can talk about 9,000, private equity firms, but the reality is that's a small number considering how many people there are in the country. Right. So understand that the word will get out. And if you are trying to deceive buyers, or you're not being truthful, or you're not, or even if you are, and it's not your fault and you're just being perceived that way, it could have a serious negative impact on you being able to sell a company. All right. Yeah. So it's the most important thing. Transparency and honesty are always key. And again, talk with your advisor about this stuff first. They will tell you, you need to tell me. What we say is that you need to tell me everything. Okay. I am going to do an audit of your business. I am going to find the stuff out. I am going to ask questions. You want me to ask these questions of you, right? Because if I don't, then I'm not prepared, and I can't talk to a buyer about the things that we want to talk to them about. And I can't give the buyer, enough information to make them happy with what they're purchasing. So the reality is that it does anybody any good to hide things or to be dishonest about stuff or whatever. And in fact, we're seeing a higher level of after the fact lawsuits happening as a result of of deals gone bad after integration. Okay. Yeah. So understand that there are people who are desperate to sell their company. Don't be one of those people. Okay. Yeah. Because it will make you do things that are going to do nothing but hurt you. Even if you are get through the sale, once these people uncover something and they see that there was something that you hid, man, it is over. It is over. They're coming after you for the rest of your life.
And another one that happens and that's a red flag is high employee turnover. And when a buyer finds out, like when a buyer gets an org chart as an example, and they see, this happened to me, when we sent them an org chart and someone had left, like in between the time that we sent them the information and then they looked at it, right? It was probably like a week and a half. And one of the key people left the company. And that wasn't a red. I guess it was a red flag because the question, we didn't have a good answer for why they left because we actually didn't know why they left. Again, that happens, but it caused the buyer to pause and say, okay, what's going on here? That can deter potential buyers if there's that inconsistency or there's a high employee turnover over time.
So you want to be able to make sure that if that's something that's happening or whatever, let's get a handle on what's going on. So at the very least, you have an answer. You can say, hey, look, these were disgruntled people who I shouldn't have hired in the first place. And I did a whole round of, and look, one of the things that might happen as you go through preparation for a sale is that you might actually, fire some people. You might have some people quit as a result of this.
Well, right. Exactly. Like we talked about earlier, like you're going through an audit of your business, right? You're going through and you're looking at the products, as Joe mentioned earlier, where you might discontinue a product. This person, as an example, could be supporting or leading a product that was unprofitable for you. Well, if you let that person go and there's high turnover based on that, well, that's something you want to tell the buyer to say, hey, in going through preparation for selling our business, we know we did some analysis and we realized that these products were, not profitable for us. So we discontinued it. And as a result, we had to let some people go in the second quarter of 2023. Perfectly legitimate explanation.
Absolutely.
Much better than you control that story and you tell the truth as opposed to them inferring something from an org chart that has changed since they got it.
Exactly right. Another red flag, maybe one of the biggest, is a lack of growth potential. Right? What am I seeing? What has been the trend over the last couple of years? Am I seeing flat sales? Are they stagnant? Am I seeing market share decline? Am I seeing what is this? What is the picture of the overall health of the business in terms of where it can go? In some cases, again, not all bad. Okay, your answer might be, "Hey, look, I'm tired." Right? There's all these things we can do. In fact, look, I had these people from Exit Engine come in and they told me all the things that I could do to fix this business. I have them written down right here. Here they are as part of my sim. Here, take this because this is where the business could prosper, right? It's okay that you didn't get it to where you wanted to get it to. It's okay, right? All you want to be able to do is to say, look, there's a reason this has been going on and this is why I'm doing this right now. Again, it's not going to look as nice as the next guy who has been doing well, okay? But there are buyers out there that you can position this in that way. Why the first thing a broker is going to ask you is, why are you selling the company?
Yeah.
Right?
Exactly.
And
and not only just the business, right? Your own business obviously is vitally important, but it could be an industry thing. You know, your industry is declining. Your industry's been in the news of being, not growing, or there's a perception that's not growing. Yet you have growth potential, right? Or your growth potential is slowed. Well, maybe your growth potential is slowed by 5%, but the industry's declined by 30%. Well, that's not necessarily a terrible thing, right? You could dominate a smaller industry. So again, these things require context. But if it's truly a lack of growth potential, you need to think about that before you sell and try to fix some of those problems before you try to sell. If truly your market is declining.
Yeah, because those things are going to obviously matter to not only your sellability, but the valuation of the company too. And so being able to identify what those things are and fix the things you can fix, and then show the things that you know about that you can't necessarily get to or can't fix, but somebody else might be able to. And that again, that becomes a selling point, turning kind of lemons into lemonade. So obviously the big takeaway here, guys, okay, is that it is you need to understand the buyer's motivations, right? Different buyers come with different motivations, different things matter to them. They're all concerned about the financial and the overall health, but a weight might be heavier on is this a good culture, might be more important to one buyer, whereas another buyer might think that its growth potential is the most important thing. So again, being able to understand who the buyer is, and one of the things that we help you do, but you should be doing no matter what, is that you should have different versions of your sim, right? Based on the buyers that come to the table, right? Being able to have a compelling value proposition based on who the buyer is, not just of one single value proposition for the business, because just like anything else, there's more than one way to skin a cat, right? So
yeah. And just to build on that, the most important thing for certain buyers will be different based on what their motivations are, right? Just said differently, is a financial buyer and a strategic buyer could look at the same business and look at different things to make it compelling based on their strategy.
That's right. What you have the ability to do, though, is create documentation that highlights the strengths, downplays the weaknesses, explains concerns, right? Provides data to support the beliefs of things or whatever, and you can do those in different versions based on who the buyer is. So identifying that's another reason why identifying the potential buyer, or at least the person who's coming in to talk to you about this stuff, understanding what their motivations are helps you select the right story to tell. Right?
Agreed.
The other thing that's going to be really important is this is where an advisor can help you is in building relationships with buyers. Okay. Again, not your primary job, right? As the owner of the company. Okay. You might talk to one or two or three buyers, maybe your entire career. Okay. But what we recommend always is actually talking to as many buyers as possible, even if you're not selling right now, right? For this very reason, because you're going to get insight into what they're looking for, the trends that are going on, right? The more people you talk to potentially about selling, about what your company might be worth, or the things that you might have to do to increase its value, or how do I sell it and things like that. All those conversations that you have with potential buyers are going to be great insight, right?
Yeah. And one sort of not silly example of this, but the importance of a M&A advisor is you never want to send financial documents over in a PDF. And maybe that's
Right.
the most obvious statement in the world, but that's going to build trust and transparency when you send the information to someone like us, someone like Exio Advisors, who can go through the documents and say, Joe, I appreciate that you sent this over, but this isn't clear. We're a set of eyes that knows what buyers want and knows what they'll find acceptable, frankly. And I had someone send over PDF documents of a spreadsheet. It's like, no, just send me the Excel document. Right? I can sort of piece this together, but you're going to want to send the documents over to the buyer in a way that you'd want to get them. So
Right.
if it's a financial statement, you need to have it in Excel or Google Sheets. Hands down, make it easy for them. If it's some like a PowerPoint document or PDFs, make sure that's formatted correctly. It sounds crazy and silly, but when a buyer is getting all this information and you have these associates that are inundated with stuff, they're going to appreciate that you thought of how they're going to get the documents and how they're going to receive the documents and analyze them in a way that's simple for them.
Absolutely right. It's like seems like such a small thing, but I can't tell you how important it is. Many of these buyers, especially private equity firms, are looking at, in a day, we'll look at dozens of companies in a day. Okay. They will be looking at this financial information from a bunch of, and many of them will be competitors to you. Okay. Because again, they will operate in a certain industry. And so they will be looking at your place and 12 others just like it. Okay. And so your stuff stands out because your stuff is put together, because you've given it to them in a format in which they can see it. We're going to have a whole episode on how AI and organization using AI and the whole thing can actually help with this entire process. It can help analyze things so that you can keep everything in a place, where that you can give people access to, so that you don't have to send individual financial documents and things like that. Right. So there's software that can help you organize this stuff and things like that. There's all kinds of technology out there, and it's changing all the time. But again, the idea is to first is that you have to understand, just like you do in your own business today. When you started this business, you saw a problem, right? You saw a customer potentially with a problem that you could solve. You developed a business that solves that problem. You get to customers, and when you talk to your customers, you ask them what their problem is, and you say that you have a solution for it. There's nothing different about this, right? All you're doing is putting it together in a way in which it makes the most sense for as many buyers to be able to come and get access to the information that is your company, right? The one of the things that, again, that you get to do in this is like selling your house, right? You're going to have a nice write-up about what your company did and where it came from and who you are and all that stuff. That stuff matters. Okay. It really does. It gives people a real flavor for what they're getting into and what they're liable to encounter in an integration situation. Okay. So great example of this is a company that we work with that basically the company was just like, everybody loved this woman. The owner of this company was everybody thought she was the greatest thing since sliced bread. She was kind. She was considerate. She was generous. It was a beautiful thing. All she did was basically as a result was trying to sell this company, was turn buyers off because they felt there was no way that they were going to come in and maintain this culture. Right. So the business was good. Everything was there. Right. Okay. But the problem is that the culture is too good. Okay. That again, there's not a whole lot.
The culture is too good, but irreplaceable, right? The person who was fostering that culture and leading that company was irreplaceable in the sense of who do we put in this? It's not going to be, the person from the private equity firm. This person is going to be bought out. They're going to leave. They're going to go do something else. It was impossible to replace it. So again, with all those, if they're looking at 11 other companies and they have 11 other companies, maybe this company's financially sound, but it's too much risk in replacing this wonderful owner in the future. And it would invariably, customer retention would invariably go down when this person leaves. So you have to think of that type of thing when you're talking to customers. Yes, you want to talk to customers. You don't want to be irreplaceable to those customers.
Right, exactly right. There's got to be a way for you to be able to disengage, and we know that. But again, building the culture is a good thing. It seems like a good thing. Everybody loves it here. I don't have any employee attrition. I have everybody stayed here. Everybody comes and works here and stays here forever. It's the most wonderful thing in the world. And it ended up being the downfall. We were able to actually eventually find a strategic buyer for her. But the idea was that she had a bunch of private equity companies come at it, and they were turned off by the fact that her culture was too good. Like, how can you win in a situation like that?
And they don't say that, but they say they use code words and they use other language for that. But yes, Joe's exactly right.
But the idea, again, we can still address that. Okay, we can have people tone down. There's lots of ways in which we can make that feel right. But again, you got to know the questions to ask. It's not about having this. What we say here all the time. It's not about knowing the answers necessarily. Okay, It's about knowing what questions, because that's what's going to guide you through this process. Understanding who you are, where you came from, what you've built, how it exists right now, what the future of it could be, and then being able to put that together in a format that makes sense to whatever potential buyer is coming at you. Sounds like the simplest thing in the world, right? But we all know that basically it is not necessarily everybody's core strength. So the takeaways today are, again, know your buyers, learn who your buyers potentially could be, understand the information they want, what motivates them, what to downplay, what to highlight, in your own business. Make sure that you're providing the information to them the best way they possibly can, and at the same time, hire an M&A advisor. Okay, I mean,
and also, something that Joe mentioned that's really important, that there's no, you can tailor your company's SIM or your company's pitch and story to the different types of buyers that are out there. There's nothing wrong with that. Again, some things in your business are going to appeal to certain types of buyers. You want to highlight those types of things to those buyers. There's nothing wrong with that.
No, exactly right. In fact, it's the way it should go. It's just a good just marketing 101, right? At the end of the day, sales 101. So anyway, I hope that's helpful. Guys, again, if you ever have a question about anything, okay, you can go to our website at myexitengine.com, and you can actually look at the top menu under Connect, and you can actually ask an Exit Engine advisor anything, okay? What's coming actually in the next couple of weeks on this website, and John may not even know this, but John, what we're having coming up is we've got actually an AI assistant that's going to be coming out on the Exit Engine website, both on the front end site as well as on our learning site, where you're going to be able to actually ask our AI basically anything and actually get a really good answer. I'm actually excited to actually try this stuff out. So look forward to that. But in any case, right now you can go and ask us anything you want by simply sending us an email. You can send it to info@myexitengine.com. You can subscribe to this podcast. You can follow us online. We're constantly we're posting stuff 5-6 times a week, information that you could really use on LinkedIn. Find us everywhere. We're Exit Engine. My name is Joe Stapleton. This is John Kniff. Thanks again, guys, for listening. Please don't forget to like and share this podcast with someone, a business owner that you love. They will thank you for it later. I guarantee it. John, thanks again, man. Have a great day, and we'll talk to you soon.
Thanks, Joe. We'll see you.